would love you to introduce yourself to our community, and then we'll go through the bunch of questions that we have already discussed.
Well, thanks for having me, Ankit. Love what you're working on here and doing some incredible work, bringing everyone to the forefront of some of the really pressing material difficulties in our global financial system. My name is John Wooten. I started learning about investments when I was working a minimum wage job at Subway. And the way I got into it is I was doing school, I was running cross country, I was working this job, not all in that order, but there was a lot going on. I was writing a book, um, and I started to realize when I was working for someone else that really I didn't have control over my financial future, and it got to the point where I boss was he was a nice guy to me. He let me work underage, and it was a really great experience learning and developing in the common workplace environment. But he wasn't, so to speak, the best to everyone, and it got to the point where so many of my coworkers left that I would work open to close on weekends completely alone, on top of the schoolwork, on top of everything I'm trying to do, and working a large number of days in the traditional week after school as well. And it was a whole lot to handle. And I was making like minimum wage for all that, and it's like, well, okay, is this really what I want? So I started researching every spare moment I had on investing, the markets, and I don't know where it came from, but I tried so many things before that never really went anywhere, and I found this guy on YouTube who was trading stocks. His name's Ross Cameron, and it really inspired me. I'd never met him, just stumbled on some of the content and said, wow, this is pretty cool. I love what's going on here. I'm going to learn as much about this as I can for the next half year. And started making my first few investments here and there. Had some winners, had some losers. Probably should have held all of them, honestly. But when the school year ended, I turned in my 2-week notice and I quit my job to trade stocks full time. And in the first 2 weeks in a paper account, I made more than the entire year prior. And that really opened my mind up and said, wow, there's some real opportunities, a lot you can do here. And the power truly of self-education and understanding nuances like these. And since then, that's led to just a whole trading career and building that into a small friends and family fund. That fund did about 2.4x over the course of a few years. A large amount of it was in crypto. And through that, over those years, I saw firsthand the crypto markets developing, the trading interfaces developing almost like the 1990s of brokers going onto the internet. I mean, that's sort of the level of technical sophistication. You see some of the major outages, some of the large incidents. It was really interesting to see capital formation at its core culminating into this newfound market when the assets were just and that was 2017, and it was really quite something, because when the summer ended and I had to be in high school from 9 to the trading hours, the only thing I could do was trade crypto because it's 24/7, it's permissionless, and I was still underage. So I was using this like circumvent where I'd go under my parents' account for stocks, and on crypto they never check any of that, at least back then. So it was much easier to access and trade the markets, and it was all the same patterns and systems that I wrote about in my book, which is free, and was using all those same strategies to trade, and it's doing really well up until the end of, obviously, there was the crash that came, but actually it wasn't the crash that got me in 2017. It was sending a very large amount of money through getting caught up in these scams where I would send crypto, and when you pay with Bitcoin, there's really no recourse, there's no trace back, and there is nothing you can do if you don't know the legal identity and personification of who you're dealing with. And that was a big ending point for me. Does that make sense, Anki?
Yeah, no, I didn't want to disturb you, but just wanted to highlight a few things that you mentioned there. So you were 18, did you say, back when you started your trading journey? You
I was
were
16.
16, right? So you were
Well, I was 15 before I quit my job, but whatever.
right. So you were 16. You were at the high school working parallel. Started this trading. This is not the time when you had the fund, or this is fund at the very beginning you started the fund.
So right around when all this was happening,
Right.
there was a lot of excitement around crypto, and that was really the big draw. And again, it was small. It was really just like my mom and dad wanted me to help them get some crypto to start off, and that's how
Yeah.
everything stemmed from it. And
Right.
so I do that with them, and because I've been doing it for a while, I work it with them. It was really simple, basic custody stuff. And
Yeah, that's amazing. Can I just ask you? So, what got you in crypto in first place? Like, why crypto? You could have gone the traditional route, and did you have parents that were wanting you to get into crypto, or why you got into crypto, and what made you, start in crypto?
so I learned about crypto in about September, August of 2017. I stumbled on this Reddit post talking about how Ethereum had just reached like a couple $100. And I kind of ignored it and was like, okay, cool, and went back to day trading stocks. And then I went, and the school year, so then the school year started coming up, and I realized, like I said, that I couldn't trade how I was trading during the opening bout. I'd have to do swing trading, or I have to do more longer term investing. And I love what I was doing. I can't express how much day trading is just the greatest thing on the planet, and you should
Yeah,
really
it
look
is.
into
Yeah.
it. It really is capitalism at its most nuanced and active role, figuring out in real time the value of an underlying asset. It's just a masterclass in
Yeah.
economics, if you ask me.
Awesome.
Um,
Yeah. Sorry.
so in a couple of weeks, I checked back on this Ethereum thing that I'd heard of on Reddit, and now it was twice the price of what it was
Right.
before. So I was like, wait a minute, there might be something here. Maybe I should like look into what's going on here.
I see, I see. So Reddit post got into this thing called Ethereum, started trading Ethereum. Within a couple of weeks, the value jumped up twice, 2x, and now you're happy and you're in the markets now.
Yeah, I didn't really start in Ethereum explicitly.
Okay.
I started researching more about the industry after that point and trying to understand what is this whole blockchain thing.
Right. The blockchain,
And
right? 2017 is very early, I must say.
yeah, I mean, I've read way too many white papers, way too much technical documentation for over the years. I remember walking into my high school math teacher and asking him about the Mimble Wimble protocol, thinking he was going to understand. It's like, I don't know what this is, John.
I
um,
see.
it was a really big turning point for me, though, because I had a few $1,000s saved up from working at Subway. I was living with my parents, obviously, and didn't really have any living expenses, so to speak. And I basically made a choice. I was looking at Bitcoin. Bitcoin was about $2,000, and I was just understanding how everything worked. And I said, should I invest in Bitcoin or the mining platform I had uncovered at the time? Because I didn't really understand holistically kind of how mining works. And I'm a big portfolio guy. At the time, I'd been doing all this portfolio research. So when I thought about mining, I thought, well, maybe I shouldn't just mine one coin. Maybe I should mine a spectrum of coins and get the aggregate income. And so I turned to NiceHash, which is a pretty popular aggregator platform. Yeah. And what I didn't realize is that NiceHash, 90% of what they were doing was just mining Ethereum. So
Ethereum.
it's the same. It's just like whatever, right?
Right.
But you get paid in Bitcoin. And I thought, should I? And I had a pretty extensive background at that point in computers. I built a gaming PC like freshman year, and I was a computer nerd. I grew up playing video games, and it was probably in middle school actually, but I grew up with video. I grew up Minecraft was like how I got into. It's how I survived middle school, really. And and then I spent far too many hours in Team Fortress 2, enamored by the trading mechanisms. If you've ever played, they have this inbuilt economy where you trade hats and items for these currencies made up of in-game commodities. And I did that for years, from 12 to 14, so roundabouts, and absolutely loved it. I remember growing my account value from $15 to $70, and I swear it was like the most immaculate
Yeah,
experience in my life.
right.
I was like, wow.
I bet, I bet. But that's amazing to hear your background. So this is the early days of when John is getting started. and crypto blockchain thing is is up and coming. I think 2017 we did have a run up right towards the end of the year. So this is pre that I'm assuming here, right? So you got in, you started trading now. What has been your journey now leading up to obviously 2024 when we are sitting here talking? You are the CEO and Chief Compliance Officer at Block Trade. What's been your journey so far, and what's your role now? Because I think I want to pivot the discussion more into the core topic that we wanted to discuss, which is who really owns your shares. So yeah, I'd love to hear like how's been that journey and what different things you have done leading up to today.
Yeah, let's jump right into it. As to who owns your shares, I think that's sort of the overall, yeah, and it's a big question that has a very simple answer, unfortunately. To put it in perspective, you might remember in late 2017, Nice Hash was hacked,
Yeah.
and I lost basically everything I'd been working on for 5 months, so to speak. And that was a real eye opener for me. It's like, wait a minute, this central institution that is the core, it was and very popular across the industry, can suddenly just lose all of your money and you're screwed. And
Mm.
like what? And that, in my view, is very similar to the present regime for securities trading and custody and the settlement system enamored in DTCC. Because, as you know, I understood none of this at the
Mm.
time, but over the years, starting to trade options, starting to trade Forex, starting to trade crypto futures, I saw all these same things happening over and over where there was this central depository, central intermediary, central custodian that controlled really what your account balance was. And as someone who's held crypto at a number of online exchanges that nowadays they don't have a website, it's they're gone. I've really seen this custody challenge firsthand, where if it's not in your wallet, if it's not your keys, so to speak, well, it might just not be yours.
Right. Right.
And unfortunately, the parallel to the securities, the bonds, the traditional financial system is things being held in custodians whereby the assets aren't in your name. They're in
Mm.
the name of that custodian. And if something goes wrong, there's this growing movement of understanding that real laws exist to give the custodian your assets if they go bankrupt. Recently, Celsius went under, and you can see people getting sued by the Celsius bankruptcy court for withdrawing their money from the platform just before it went bankrupt. And I am extremely terrified that that will happen
Mm.
for traditional, mom and pop retirees that through no fault of their own thought they were investing in a secure platform, but because of the malfeasance and inadequacies of the central intermediaries, all of a sudden there's a $3 billion hole in the balance sheets.
Yeah, yeah, and we've seen that Celsius is one, obviously, and then other one FTX that happened in 2022 as well, right? Exactly same thing, centralized entity that went under. I think it was around what $50 billion, if I'm
Oh, okay, there you go.
right. So it's even bigger than that, and I think we're still going through the bankruptcy, right? Chapter 11. They're trying to restructure in some shape or form, perhaps emerging soon. What I remember, but I think what you're saying here, John, is you do believe in not your keys, not your coins, which was the central theme for Bitcoin early days, I would say. I think it has evolved a lot now, given all the centralized exchanges. Look, I think centralized exchanges do have a place, and they do play a role. But I think the core principle, what you're defining here, and they are nefarious parties, right? Be it the risk they take, these certain entities, or be that there are some nefarious actor within those entities, right? Things do go wrong. So, we are personally biggest proponent on not your keys, not your coins, right? I think we should all hold all, especially crypto that allows you to hold, right? Now, coming back to the security side, it's not like it's a almost unknown fact it's not been discussed enough. Like crypto, I think since the early days that's been discussed. Like if you were early Bitcoiners, you were keeping your coins in like your cold storage or your wallets or somewhere else, right? You're not believing in the and I think one of the facts that I came across was like 76% of Bitcoin hasn't moved in years, right? So people do keep it in the hard wallets, right? Cold wallets. But on the security side, traditional markets, that hasn't been the prevailing theme, right? There's no one. I mean, crypto is like what 15 years old, but traditional markets have been around for so long. Why people haven't discussed this topic, and why the traditional media hasn't talked about this?
It's quite unfortunate, and so much work needs to be done here on really getting everyone to understand. I will challenge you and keep question on what do you mean exactly when you say you think there's a role for these centralized exchanges?
Yeah, I think when I say role, like centralized exchanges for me at the current stage provide something that like the DeFi sector, right, can't do today, which is in 2024, right? Centralized exchange provide liquidity for trading assets, right? So if you want to exchange your Bitcoin quickly, sell it, buy whatever that is from currency to Bitcoin, Bitcoin to currency, it might take you a little longer to do that if you're doing on the decentralized exchanges, right? Or OTC. But on the centralized exchanges, you don't have to worry where to find the buyer because they are the buyers themselves, right? Market maker. We can go into mechanics side, right? So when I say they provide liquidity, I think that has a role, and I think that's been the biggest justification on the traditional market side, right? That's been the biggest justification that hey, we are the liquidity provider here, hence we are allowed to do what we do. And I think yes, it does have an argument. You can make an argument, it's possible, but I don't think for the reasons you're defining, I'm disagreeing. I'm agreeing with you, but I think they do have somewhat role. How they're regulated, are they playing being the honest player they need to be? Those are the discussions we can have. But I think there is liquidity does play a role when someone wants, especially mom and pop, right? They don't want to think about getting in and out of some currency if they hold. They just want to buy it and put it in a wallet or whatnot, right? Or just keep it on the centralized exchange. Does it make sense?
So when you talk about liquidity, and specifically, I think you mentioned the exchanges acting as sort of market makers. Can you tell me a little bit more about that, Ankit?
Yeah, yeah. I think I'm not necessarily saying the brokers, let's say exchanges, are acting like a market maker, but they could have market makers that they're working with, and we know there are market makers in both on the DeFi side. There are AMMs, and obviously on the centralized sides, there are traditional players that have jumped in, like the Citadel, I think, is also doing some crypto market making. And then there's obviously subsidiaries of these big market makers that have jumped in now. So I think market making is one side, but the brokerage themselves, the exchanges, they obviously connect with them, right? Their business is slightly different. They obviously play on different roles, like they're creating pools. They're obviously making money on perpetual side. Spot might be some bits. So I think, and also listing fees, like most of the centralized exchanges actually make money while listing fees. So I'm not necessarily talking about the different roles they play, but I'm saying like together as a whole, when me as a retail investor go into the centralized exchanges, what I'm looking for is quick liquidity. I'm looking to buy and sell and get out and go about my life, not to worry about where and how to find it, and how much the price moves if I have big amount that I'm trying to sell for a non-liquid coin, right? On that happens for a lot of coins, especially in the illiquid market like today, right? So that's what I'm defining, not necessarily market makers.
And Ankit, do you think the future of liquidity stands with firms like Citadel, or should it be more democratized through things like AMMs?
I think eventually it will be AMM, and I would like it to be AMMs, right? And I would like it to be algorithm driven, right? Which is what AMMs are today, even though they might be designed by centralized entities. But but they are eventually, when we can get to a place where that a GitHub repo is posting a AMM, and we all know the rules of that AMM, right? And we all agree on the rules. Then I think that's the best place to be in. But I don't think we're going to get there anytime soon, right? We know a lot about AMMs, and there's especially on certain DeFi protocols. And you can learn about them, especially on the when you're LP putting some assets on, when you're swapping assets and stuff. You know what the slippages are. But what you don't know now on the DeFi side is the mempool side. What's happening on the mempool? Who's front running you? So I'm saying, like, even though we can all talk about that, and I think there's a lot of those discussions within the crypto world, but I think people tend to skip over the same issues that we are seeing in the traditional markets are starting to happen, especially on certain assets, right? Special certain blockchains, I must say. So yeah. So John, I'm coming back to that point now, that we were just discussing. So your thesis is around that we all should hold our keys to our asset, right? Be it securities, be it crypto. So like that leads me to my next question, which is, you obviously self-proclaim yourself as the chief compliance officer, and I believe you're a CEO as well for block transfer. What made you start block transfer? Is it the same principles that we are just discussing now, that people need to hold their assets in their own custody? Is that the reason why you started? And what is block transfer?
Sure. Just one brief thing, because I'll forget it, and just want to
Yes,
make
please.
sure. So, I'm actively in the process of decentralizing the company and making it a fully open source syndicate of the whole everyone that's involved here, the stakeholders, and it becoming owned by a decentralized unincorporated nonprofit association. So I really try, I don't like, we're sort of, there's not like assigned or statutory job titles, so to
I see.
speak, for, yeah. So and there will never be a CEO. If there's a CEO, it means we got a venture investor and something went wrong along the way,
Right.
and we're not aligning with that nonprofit mission. Um, so the way I got into it is I was in this really strange niche of financial products, and over the years I had seen, you talked about, earlier, 5 to 7% hidden little trading fees that make their way into the investment process. And for a normal person, maybe you don't see that. Maybe it's hard to tell that this retirement fee compounds and compounds and compounds, and in 40 years, it's a very sizable amount of money. I think the average cost of all these systems compounds to hundreds of thousands of dollars for someone just saving, maybe $1,000 a year or a month, for 40 years in a normal market condition. And this idea of compounding fees is one of the core driving factors behind everything that I do. There's also the access problem for the 7 billion people on the planet who don't live in America, and or the 300 million people in America that want to invest abroad. I mean, that's a real thing too, 100%. And there is the equality, and you referenced MEV attacks on EVM chains. There is, and there's the same problem that we have with the market makers that pay 500, that pay millions of dollars to sit right next to the New York Stock Exchange so that they can trade faster than you. It's all the same problems
Mhm.
that we see, like you referenced. It's the same stuff, and those are all extremely large problems that I wholeheartedly see solved entirely by really the first decentralized exchange, which is the Stellar Decentralized Exchange, which launched in 2014 and has processed billions of dollars worth of transactions. the change for there was that it gets rid of all these problems. And the spearhead in my career was trading leveraged Bitcoin futures when saw Bitcoin explode up into the 50, 60,000 range for the first time ever, and actually sold and closed down the fund after that. I closed the fund, got rid of the assets, a number of assets. For a couple of other reasons, it wasn't just the price; it was becoming a lot, and it was a real big personal strain between that, trying to understand all this. I'd been researching it extensively since 2020 when I published my thesis in college under a blockchain class, and being a full time computer engineer at Georgia Tech, it was a lot,
Mm.
and um, and I yeah, there's a lot I could dive into there, um, but I realized that there was something really wrong here. Even when I was running the fund, I could see these problems, where these trading fees were just enormous. I was paying 12% of a position to a pro. Like, why? On some small derivatives, and even like just trading some major, like just trading Bitcoin. If you've ever tried to execute something through, I guess back when it was around, BlockFi, and then the arrangements between the custodial partners and the exchanging agents there, which use their central order books, it was insane. You were paying thousands and thousands of dollars a coin to access liquidity. It's unbelievable, and that was the spark. And then the fire really lit when I personally had invested in short Bitcoin leverage futures contracts right around the actual specific brokerage statements are at bitcoin.jfwooten4.com. Um, and in short, it turned a little over $200 into about $15,000. But about a third of that went to the broker in commissions and fees. To think that we are in such decades, centuries of advances in capital market infrastructure, and I'm still sitting here paying a 30% fee to a broker. And something you don't see, but was very apparent, was very relevant here, was that I had been denied trading access to these particular assets and even just Forex itself by a very large number of intermediaries because I didn't have $5 million to open an account. And so I had to go with the one that had the least regulation. It was a sketchy Cayman Islands company. I had no confidence in the money there. I was afraid, just like all the other crypto exchanges, that they would go poof.
Mm.
But there was no other way to get the trade that I wanted and that I knew I could make with the leverage profile I had. And so that trade's paying my rent today. And
Right.
to think that 5 months of my rent went to a broker, like, wow, it's kind of
Yeah.
bizarre.
That is bizarre. So that led to creation of like block transfer. Is like what was the journey from there? Okay, well I'm seeing this enormous fees that I'm paying on my trades. I need to do something about this, and I'm going to go and create something because I think that's the journey that like one goes through, right? So what was your journey and thought process to create the block transfer?
Yeah, that's right. It really started in that thesis in 2020, and then I started working on it in a hackathon in at the end of that year. And I was trading Forex at the time. I was doing polyphasic Uberman, where you sleep for 20 minutes every 4 hours, so I could trade around the clock. And even in Forex, it was just ridiculous. Like I would enter a trade, and bam, I have a 24% loss because of the spread. And so I've been seeing these immense fees on the because these are derivatives, these are leverage, these are the further end of that rabbit hole for investing. But even as the start of it, with your basic share in a public company, it's a fraction of these fees, but it's still these fees, and these fees are not immaterial. They fund a $1 billion Wall Street. They pay for Wall Street. Where do you think the money from Wall Street comes from?
Yeah.
It's either there's only three people here. Okay, there's you, there's companies, and there's Wall Street, and the only place the money can come from are over here. And so it's extractive from the returns of what is supposed to be such a rudimentary,
And
basic function.
both sides, right? It's the one who's losing money and obviously who's making money. I think it's unfortunately them, making money on both sides.
Well, what do you mean, Ankit?
Oh, I'm just saying, like like market makers are not positioned in one direction, right? They're constantly moving the assets, right? But sorry to derail you. I think we want to focus on you. So sorry, John, to cut you off there.
No, no, you're all good, Ankit. Feel free to jump in. It's a really good point and a really good question. Uh, Something a lot of people might ask is, how do these large central? I mean, I have friends that work at. I know people that work here, and their whole job is building algorithms that skim trades off retail.
Mm.
So I agree that market making is position neutral, but is it really an efficient system when somebody that has special preferred access to these exchanges can make trades you and I could never imagine making, and every time you press that buy button there are fractions and fractions of a penny skimmed off in the name of incentivizing liquidity? I think there's a real systemic problem. The faster trading gets, the more differentiated this access becomes, because that's the problem here. The problem is that your broker can trade stocks, your broker can trade currencies, your broker can access markets in a way that you and I can't.
Yeah, 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 yeah. So, John, I want to pull you back a little bit because you have so much knowledge here, right? And we can sit here discuss all of that. So want to pull you back a little bit on block transfer side. So, tell us what block transfer is and what it does in this market. What is the role of block transfer as a whole, as an entity?
Of course. So I'll put the name on the pig here, and that is CDN Company. And CDN Company is this custodian that holds basically every American security, so to speak. And
Yes.
this is one part of a basically there's this pyramid of middlemen built on top of CDN Company. So CDN Company is part of DTC, is part of the DTCC, which provides all the clearing and settlement, which connects to all the market makers, all the exchanges, all the off-exchange venues, which connects to all the brokers, which connects to the order, and there's the order routers, and that connects to the investors. So there's this chain of about nearly a dozen intermediaries in in a normal transaction.
Mm.
And the really interesting thing is that it wasn't always like this. In the 70s and the 80s, they started putting this whole scheme together of how ownership would go down into one company that legally owns all the securities of every investor. But before then, it was very decentralized. People had stock certificates. My dad told me in the 90s he was still getting mailed stock certificates for for where he was working. And to trade, the early stock exchanges of the world, they were you and me exchanging stock certificates,
Mm.
signing it over. But the problem was that transferring stock is very expensive. Ever since even the first Dutch East Indies Company, it was about $200 to transfer my stock to you. And we
Mm.
had to go to an office in Amsterdam and have two company board members stamp and approve that document. And so even though the first stock exchange in Amsterdam was literally 2 blocks away from this office where you could make the transfers, they just got sick of doing it because it's a real transaction cost to have to do that to settle a trade. And so they started trading futures and they started trading contracts, which is all futures are. They started trading contracts between each other, which introduced counterparty risk because now you could have a contract with someone and they could go bankrupt or they could just flee Amsterdam, or the court could say your contract is null and void, which is what happened when they were short selling contracts.
You said the bottom of the pile is the Seed and Co, right? I just want to emphasize on that point. Seed and Co is owned by DTC, which is owned by DTCC, right? That's the sort of hierarchy. And Seed and Co is the legal entity that owns all your shares, not you as individual investor. You're the beneficiary. They are the legal owner of your shares. Is that correct?
That's exactly right. And key, it's like if you bought a car, but the dealer kept the title. and they'll say that you can use it, but if it went to court, it's not legally in your name. And so when we talk about not your keys, it's really the same thing with brokerage investors, in that the stock is not in your name.
Mm.
And according to the letter of the law, that means that the stock is not yours. You are subject to the same credit risk of the whole system, or not the whole system. Well, yes, the whole system now, but back in the Dutch East Indies days, the credit risk was that the other party failed. And what the regulations have done is they consolidated everything into one intermediary, is that they've lowered like there's not a risk anymore that your broker goes bankrupt and you lose all your money. It's because of this DTCC is sort of the entity that makes sure that everybody can pool their money and it's all interconnected. So it's now the case that DTCs, they went from not too big to fail to too bigger to fail, so they consolidated the everything into one entity. And the argument here is that it removes the risks at the endpoints, at the tertiaries. But my understanding, and based off of extensive diligence, and you just look at the GameStop fiasco, is that the whole system, especially at the CD level, is inaccurate. At the DTC level, is, I think, insolvent. And
Mm.
this is a big thing I'm working on to make sure we can move forward from this.
Yeah.
Um,
So that's the DRS side, right? That you're working on, and that's you, like you're so passionate about it, and there's a whole community working on the DRS and why DRS matters. Like I think, but I think I just want to pull you back a little bit. So I think let me be this person, right? I'm just entering the market now. I don't know how markets work, so I have one of the brokers that I use, right? I now want to buy Apple. John, please explain to me what happens when I execute the trade. Like, what are the different routes? Because you're obviously talking about, skimming of top, like commission structures, incentives. There are a lot of things that are happening in the markets today. But in a very layman's term, what happens, and who are these parties that are involved when you hit that buy button on your screen on one of the brokers that you use?
of course. Well, one thing I think is important to keep in context here, when I wrote my book on trading strategies, I had a whole chapter dedicated to different brokers and their fees. And at the time, Robinhood was the only one that came in and said, we're not going to have fees, and we're only going to use this system where we get kickbacks from Wall Street to fund our revenues. And they were able to do that by and large because they had raised an extremely large amount of money from Silicon Valley. And it was sort of, they were trying to enter the industry, just like any startup. If you lose money for 15 years by doing something that's unsustainable or bad for the end user, and then you become dominant in the industry, obviously you can extract the rents and such. So just important to remember that, when I got into the market, and even before, I mean, trades used to cost hundreds of dollars. And over the years, it's become digitized, it's become easier, and now it's ultimately become free. Of course, there are now these hidden costs in the structure of things, and those hidden costs come aside from when you're trading derivatives, because for most places today, when you trade derivatives, you're still explicitly paying trading fees. The vast majority of them still charge explicit trading fees. So one part of it is you go to your broker today, they get paid a fee to execute that order, and
Right.
even if, yeah, okay, or an advisory fee or whatever. So you make the trade, you buy the stock. What does the broker do? The first option in their toolkit is internalization. So the broker has your order, but they're a big broker. They might have another order from John over here, and Keith wants to buy the stock at 10. John wants to sell it at $10.02. The broker will match that trade, and by and large, they keep the 2 cents in between. So they just, as long as that's within the market prices, then they're completely allowed to do that. And they don't have to actually send liquidity to the market. They don't have to let orders compete, and they don't need to have a transparent exchange. Instead, they can just do it locally, keep the profits. And this is the biggest challenge we're going to see as they dive into all these other options, is every option I tell you about how a trade gets filled is taking price moving volume. Your trade should have an impact on the price of the market. My trade should have an impact on the price of the market. And when we don't get filled on an agreed upon central market, and when I say don't get filled, I mean when our order doesn't get there. An order book is sort of how we define these markets. And an order book is just a list of the buy offers and the sell offers. So you have your buy, I have my sell. If those orders don't make it onto an agreed upon central order book, then we are not moving the market.
Right, right. So you're saying if they're not going to the lit market, which could be Nasdaq or one of the other exchanges, we it never even hits that market, right? It just goes to some sort of warehouse. I think that's the analogy I love personally. It just hits the warehouse, and then the person in the warehouse, which could be brokers, just exchanges the buy and sell, and just matches two parties together without even us hitting the way we think about the trading.
Well, I like to think about it like we're shipping your trade in a box. And internalization, just at this beginning step, we aren't even making it to the warehouse yet. We're making the deal in the back of the
Right.
truck.
That's even better. Yeah.
And it's even further away from public oversight. and and there is this system in place today that kind of puts all these major stock exchanges in one place. And the reason there are so many stock exchanges is solely because they compete on the prices that they charge your brokers, or the prices they'll pay to your brokers to send trades and to execute trades. And so I think that's an important point. The only reason there's competition on the trading space from the earliest of days was to undercut the exchange rates on another platform. And I think we've seen in these past couple decades how undercutting leads to the end result, which is free through Robinhood.
Right.
The end result of this is it's just a fight to the bottom.
Right. Which leads to, as you said, Robin Hood, which is payment for order flows, right? That's the term that industry uses, that they survive because of payment for order flows.
Yeah, so if they can't match a trade with someone else's trade, which happens normally about 10 to 13% of the time, then the company that is your broker, because brokers are just companies, okay? They have stockholders, they have debt, they make profits. A lot of them are public, so you can even be a stockholder. The brokerage has a choice to make after, crucially, it pings the market and asks what the current prices are. So your order's here, it has to go ask what the prices are. Then it comes back and it says, can we internalize this or not? And let's say that the answer is no. Okay, well, now they're at this step and they need to figure out what to do with that trade. And this is when a very large number of brokers employ that the brokers that you're familiar with, the brand names in the industry, they might be called custody brokers, whereas a very large number of them employ what I'll call a trading broker. So the trading broker is where they'll send to actually execute the trade. And this is another for-profit broker that's sort of in the middle of your operations here, because the market is extremely complicated. If you think about, we started when I'm talking about crypto, if you think about like DEX aggregators, you can imagine what I'm talking about here with a trading broker. It would be like sending your order into a DEX aggregator where it's checking all the different fragmented sources of liquidity, because there are hundreds of these off-exchange venues. There are dozens of these regulated off-exchange trading firms. And of course, there are dozens of national securities exchanges. And it's a lot of work to compile. Imagine you have to have APIs, and a very large number of these APIs. And when I say APIs, all I mean is the link, the computer connection,
Yeah.
to trade on such and such hidden marketplace that you and I will never be able to access because we're not broker dealers, Wall Street, super wealthy. To trade there, you have to pay $5,000 a month. So they'll have 100 of these things set up so that they can access all these secret places where you can trade at prices not reflected on the normal stock exchange. And so most of the brokers will outsource this, and then a couple of the really big ones do it themselves. But for this example, for most of the retail brokers, let's say they outsource it. So they'll take that order, send it to the trading company, and the trading broker has a choice here for where to send these trades. And by and large, when it gets sent to that trading company, the end result is not the best price for the investor. Now, you might think, how is this possible? There are all these laws in place that say you have to get the best price for the investor. But in reality, those laws are based on the lit market. They're based on Ankit's order getting to the stock exchange, John's order getting to the stock exchange. And by and large, 80% of those trades don't get to the stock exchange.
Right.
And because of that, what you see as the price range is really inflated. It's
Mm.
artificially higher than a free market where the liquidity is consolidated and equally accessible in one place. So that gives all these hundreds of other people trying to make money off your trade, these different places where you can execute transactions if you're a broker. It gives them a very wide range to play with, where the market makers will go there, submit their orders there, and it might be the same as what you see on the market exchange. But the thing with the stock exchanges is that they are expensive. And when I say expensive, I mean hundreds of pennies. They're expensive for the trading broker to route to, because you have to pay hundreds of a penny per share that, what for what you send over there. There's a fee associated with that because they are a centralized for-profit company. A vast majority of the world stock exchanges are held under a company called Intercontinental Exchange. It's a public for-profit. Their stock price, it looks like up and to the right, and this is their business. Aside from selling special access feeds to market makers, that's a whole nother
Right. So
segment of
that's
the
ICE, right? So that's ICE.
video.
Yeah, it's the short form for them, right? ICE, right? But that's amazing, John. That's so much knowledge that you sort of sharing with us, because I think hardly like I've spent a lot of time last 4 years myself learning this through, right? And there aren't many places where you can really go to find out this knowledge, and that's why I wanted to have you there, because I think your knowledge is it's just fascinating, like when you sit and talk to you, which I've done a couple of times before. But one of the questions while you were talking about these certain venues that are accessible to Wall Street, not to the retail, one of the things I wanted to know is what are the settlement cycles, because I think there are topics that are ginormous topics within themselves, right? Settlement cycles would be one of the ones that we can spend an hour discussing if you wanted to. But quickly, we'd love to know. So, okay, so now we've hit the order. Order gets internalized by the brokers themselves. They send it to trading brokers, right? It never, like I think Gary Gensler said, right? It's 96%, 94% of the orders actually never hit the lit market, right? I think it was from his mouth. So the
Yeah,
big portion of orders actually never hit the lit market, which is the commissioner of SEC saying, right? That's amazing too. And
it's unbelievable.
it is unbelievable. So coming back to it, so what happens from there? So okay, now brokers and trading brokers have internalized my order. I get the shares that I was looking for. Someone gets the money. Brokers get the money. Internal trading brokers get the money. What happens now from there on? What gets printed on the tape? How does the shares settle? Where does the DTCC and CDN Co come in this whole process?
Yeah, I'll start on the tape. So after that, let's say it executes on this alternative venue and they pay their fee, or they pay a rebate. So they're paying you to send the trade to them. They pay that to the trading broker. The trading broker pays that to Robinhood. That's 80% of Robinhood's money or so, something like that. And that's why 85% of GameStop was internalized at peak during everything that was going on. Now it's the same rules for settlement. So the cool thing is settlement is always really the same process. No matter where it gets executed, there's all these different places you can trade. But the settlement's all through DTCC via their NSCC system, which a lot of acronyms there, but just a common platform that the industry, it wasn't always like this. So in 1975, there was a law passed by Congress that was supposed to promote competition for trade clearing and settlement. And at the time, there were nearly a dozen and of course some smaller ones, but a dozen big ones. And they, over the years, over the decades, the law that was passed required that if one clearing firm does one thing, then everybody has to do it. So DTC was the biggest one. It was out of New York. It was sort of formed originally by the New York Stock Exchange. They had the most capitalization and resources, and of course they had the most IBM mainframes out of everybody at the time, which are still in use by and large, which is unbelievable. It's the same freaking COBOL code 60 years later. um, and because of that, they led the industry in building out new features. And now they have this unbelievably complicated swath of technology that you and I can't see. And we can't look into it. It's completely opaque. We have no rights to understand and access how this works. The very, very limited amount of public data we have on settlement failures comes from years of intense legal action from Overstock in the early 2000s that led not necessarily to Reg Show, but led directly to FOIA requests that required DTC to publish periodically on a 2-week delayed basis information about what they consider settlement failures, which is materially different from a number of people's perspective on some of the challenges they have.
We were discussing about the settlement cycles, right? So you're discussing how the cycles happen and how, even though you're trading in different brokers, they all come to the same place, which is DTCC, right?
Yeah, they all come to DTCC, and supposedly they net the positions out. And if your broker, if we're at the same broker, and there are a million trades, say we're trading some stock, and in aggregate, after there's different brokers, and the shares move from one broker to another broker's account at DTC, because everybody at Fidelity might think that the stock's going to go down, but everybody at our broker might think the stock's going to go up. So let's say Fidelity for the day, because it's a daily thing, say they're net short 3 million shares, and at our broker, after buying from everybody else, for net long 1 million shares. So they'll balance those out, and they'll transfer the 2 million shares over. Its central clearing, central custody, and a central hypothecation. You connect everything that happens here, and it's just moves the shares only that need to be moved. So crucially, there might be 100 million shares that of buy orders from our side, but it's only that small fraction that actually moves between the brokers on the books of DTCC through the NSCC, which is the clearing side. And then, very crucially, absolutely none of that trading makes its way down to CD. It doesn't actually change the legal ownership of either broker, either broker's custodians, or either broker's investors.
Right. So it doesn't need to, because they are ultimately the legal owners, right? Seed& Co. So now, just like the banking system has a settlement cycles, right? Every night it's clearance, right? Bank to bank, they do clearance. You're saying netting is the similar system that happens within the brokerage, right? And DTCC is the clearance corporation that handles all of the clearing and does the netting.
Yes, and what netting allows is the introduction again of this credit risk, where the broker might have 100 million shares of such and such stock theoretically held in custody, or assigned to its investors, you and I. But in reality, they're only moving a couple million shares maybe a day on the high end, if they're not internalizing at all. And so DTCC looks at that and they say, okay, well, you're barely moving any stock. So you only need a small fraction of money
Hmm.
of the value of what you're trading. And what happened with GameStop is that all of a sudden, this small fraction of money grew to be larger than GameStop's balance sheet if they didn't halt the trading, so to speak. And that's the risk that gets introduced at the clearing level, because these positions are not fully funded. The money that you put, when you think that you're giving your broker $100 per share to buy the stock, $100 per share does not go to the clearing entity. It sits in the broker's pocket, and they invest it in treasuries, or other assets, right? And so the real risk here is, okay, well, a clearing firm fails, and recently the SEC did an investigation on the OCC, which does it's the exact same thing for options contracts.
Yeah.
And in that, which is referenced at occ.jfwooten4.com for the actual the document is the third footnote, if memory serves me right. In that document, they stated that if two brokers, two clearing members failed, the entire system would collapse and go bankrupt. So that's the real risk here when we look at what could be a repeat of Lehman, where all of those securities that they held were custodied by a broker that lent them money. And so the securities, they went within the span of 4 minutes. It goes from their account, whoop, now it's in our account. And all your investors, it's nothing. It's gone. It's not theirs anymore. And that is the real tangible risk I see here with the way that this system introduces unnecessary counterparty risk. Historically, it was the only way to do it, but nowadays with blockchain, there is this alternative solution
Right.
where you can just have a debit-based system that works for investors, for companies, and not for Wall Street.
Right, and also introduces this whole takes away this whole concept of counterparty risk, because I think we in the tech community, in the even the financial side, no one, maybe Wall Street obviously knows that well, but I think in a retail segment, retail investors don't never discuss and never even understand how important the counterparty risk is actually for Wall Street, and how much of the Wall Street revolves around counterparties, like all the swaps. Actually, if you get into the derivative side and swaps, it's just fascinating when you get into those the data points, like how the counterparty risk is established, and a little bit of that you see on the debt side as well, corporate debt, how the different tiering structure works and whatnot. But there's a discussion for a different day. But John, look, I've taken a lot of your time, and all the information that you've given us is already like mind-boggling. Like if you're new to this, right? Now I would like to have you back. I think I want to maybe perhaps finish this off here, and perhaps have a different session with you in a different time when works for you, and just go through how you see blockchain solving some of these problems, right? Because you are in blockchain now, right? So far, we've discussed your background, we discussed how you got to block transfer, what are the fundamental, like how the market has evolved. Because I think we can all sit here, we can argue it's good or bad, right? Because a lot of people can say this is how it should have evolved, it could have evolved, and it is the reason it's evolved. But I think I want to look into the future, because I think there is a future, and also there's a little bit of historical lesson, because I can almost see two different um, discussions here. One is the GameStop saga, because I think that's a beautiful, beautiful one, and we both have seen a different perspective, right? And the second one is the blockchain, which is the block transfer itself. What you guys doing? The whole technology side, the future that it could hold, the T0 side, the speedy route, which we were discussing, like the part of the entity that is a part of T0 and is owned by ICE now, or partly owned by ICE. There's a lot there, because I think that's the future that we're building now. Would that be okay with you if we can sort of have another session, and whenever it works for you?
Of course, Ankit, love the transparent public disclosure. And you hit it really on the head there, where we're at a turning point, and the market and investors at large need to make a choice whether we're going to allow the problematic centralized order books of the past continue, where there is a for-profit company operating the exchange, or move into this promised decentralized future where the orders, the trades, and the execution is determined entirely by protocol.